Good evening, ladies and gentlemen. Today is the 12th of May, Wednesday, but also the weekly expiry. This is because tomorrow is a holiday, market holiday for Eid, and happy Eid to everyone celebrating it. I hope you have a great time with your family. And being an expiry, the expiry more or less the entire day was extremely mum and went exactly according to plan. Towards the end, there was a big 100-point down move and a 50-point recovery, and I couldn't react in time. My execution was a little bit off, where I got burnt slightly on the down move, and then I got burnt even more on the up move because I tried to take short positions at that point of time. Regardless, closed up 2% positive, and I think today is a great day to put across how you can never consider your mark to market a profit. Your profit isn't done until you've booked your position, you've got up from the seat, you've left, market is closed for the day. And if you're an intraday trader, that is when your mark to market is profit. This is really important for psychology as well, because if you feel like, oh, at this point I'm sitting at this much profit, I could have booked it, it's never going to help you trade successfully, because had you been doing that, you could have booked much earlier, maybe before you were at a larger profit. So when do you know when to book? So at every point, it's important to know what is your potential risk and what is your reward, right? That at one point of the day, I was up 4%, but I could potentially gain another 2%. So my idea was to put 1% on the table to gain another 2%. Due to some execution errors, that 1% ended up being a 2%, and you can't complain. That's just these things happen. So very, very important to realize that mark to market gains are not your profit until you get out of the trade. Secondly, I'm making a video for tomorrow. I will be coming out tomorrow, which will be on India VIX. How does it work? There seem to be a lot of people who have slight doubts about how the entire thing works. So that will be coming out tomorrow. Also, with respect to the OI, the kind of build up that was there at 14,800, I posted that on Twitter. If in case you're not following me on Twitter, please follow me at Bandi Shreyas, and you can follow at Nifty PN. We keep putting up whatever relevant data is available during market hours. Also, if you want my entire order book, I've been sharing my order book every single day for the past few months on our Telegram channel, which is completely free. So you can check that out as well. I hope you had a good trading expiry, and I hope you didn't get burnt by that last minute down move. The pricing of options was really not pricing in some kind of a 100-point move, but that's how expiries work. That's what you sign up for when you're trading on expiry, and that's the nature of markets. So thank you so much for watching. I will catch you on Friday. Please take care.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. The pre-market has just settled. It is 9:10, and more or less we're opening gap down by just 30 points. What my expectation is that from here we will see an immediate 40 to 50 point down move at least, and we will see a massive amount of call rating at 14,900, 14,950, and 15,000, and there'll be almost no value left in these strikes. From that dip towards 14,750, we might actually see buying pickup with a lot of plus minus movement around 14,800, but at the open we should be dipping most likely. And the idea for the day is to stay relatively risk off. I will wait for the first few candles before entering the position. I'm using a different computer for charting, but more or less my idea is so there's a good amount of put open interest at 14,800, at 14,700, and 14,600. So from my put side for the strangle, my comfort would be between 14,600 and 650, where there should be good support. And from the call side, I will wait because initially I'm expecting the 14,900, 950 call to completely tank, lose a lot of value. A lot of shorts will be created here. So the supply excess will really push the price down. That's why I'm waiting initially, because the calls will deflate quite a bit and then probably expand if we hold and then start making an up move. So the preferred range would be 14,600 to 14,950, with 15,000 acting as the upper ceiling. And on the downside, I'm guessing 14,600 should probably be the lower ceiling, considering that good amount of put open interest that's still there. One good thing is yesterday a lot of the 14,800 calls, when it peaked, I think maximum open interest was somewhere around 55 lakhs at one point. A lot of that has been unwound yesterday itself. So there are not that many longs that need to get out, but yeah, most likely we'll be seeing a dip at the open. That's what I'm expecting. Should be with a good IV spike, hopefully, and that gives us some good premiums. Okay, I have just finished entering the position. Initially wanted to enter with the 14,650, 14,950 strangle, but there's no value left in the 14,950 call, which is why I'm at the 14,650, 14,900 call. We're basically trading at yesterday's lows, and currently, from what's visible, there's actually an increase in open interest at the 14,800 put, and yeah, relatively one would think, and it's trading at around 56, which is the same preferred price at which the 14,800 put was being sold yesterday. So unless we see some big unwinding happening here and here, we should not see some kind of a downward spiral. In the meantime, how I've decided to manage today's triangle, given the potential nature of move that can come in, is by trading. This triangle is trading at 18 points, and the idea is if we are at any point down by 10 points, we'll just be exiting the entire position because it doesn't make sense after that. So going to take a more or less target stop loss approach to this expiry. We'll keep you posted. The time is 9:25. Okay, so the dip was not as bad. We continued to dip all the way till 14,750 and below. These 14,650 puts expanded by quite a bit. They went up to almost 20 at some point. And to balance it at different points, just kept moving down the calls. Now, the calls at 14,850, which is the bigger threat, they were moved down to protect the puts, but the puts have now come down in price. The idea is we'll wait for a test of 14,790, and if that is happening, these will expand to something like 1415. In that situation, we'll have to get out of this and switch to 14,900 call, which will be trading at something like 8 at that point. I am expecting there to be quite a fight because if we see, okay, OI data is not super visible right now. It'll be 10:30 before we get like a more visible structure. A huge amount of call writing at 14,800 and above, and potentially making it difficult to cross 14,800. But if we start seeing a short covering triggered, then it can be quite nasty on the upside, since a lot of people would have gone short in the morning after the gap down, especially given the whole global sentiment. And it being an expiry, anything can happen. So on the downside, I would say right now, from what is visible, 14,600 should be the maximum possible downside, and 15,000 is definitely the ceiling. The call said there's no doubt about that. So more or less, for now, the position is all right. We have 100 points up and down with about credit of 22. So it's good enough for now. And the idea will be if we start heading higher, then have to risk manage these calls. But until then, not much to do. I'm expecting quite a fight to be put up now at 14,800. Okay, we're seeing a steady down move. And yeah, Reliance big candle, almost 10 points in one candle, and bringing it to 1908. Still expecting 1900 to hold on Reliance, and Bank Nifty is exactly at 32,500, which also I'm expecting to be a support zone, which is why I'm waiting before I roll the 14,850 call down to 14,800. I'm gonna actually take on a little bit of risk here, where I'm gonna wait for a breach of 14,700 because a lot of this feels forced. It's almost like IT, Bank Nifty, and Reliance at once is an attempt to push it down, but I'm okay to let 14,700 get tested. That will give me enough reaction time to move these puts away in case that happens. So if I too quickly move the calls down to 14,800, it would be at a very bad pricing. So yeah, more or less what could cost me like 3 or 4 points. I'm just holding on for now. No need to be in a rush. There is almost 50 lakhs of open interest at 14,700, and a brute force down move on RILIT and Bank Nifty together is not something I would think will have too much follow through from these levels. Bank Nifty as well. 32,500, very big psychological level. Shorts will start booking. Okay, so one green candle and use that as an opportunity to move down half the quantity of calls from 14,850 to 14,800. The idea is half the position delta neutralizes at 14,725 and the other half neutralizes at 14,750. So basically, in case there is a down move below 14,700 for that second, the kind of gamma expansion on these puts, I want to take care of that, and for that I've moved only half the quantity of calls down to 14,800, just taking in a little more additional call side credit. Okay, so we're holding the lows of 14,700, and once again we're seeing increase of 14,700 put OI. So that being the case, the job of these 14,800 calls more or less is done. What I've done is I had previously moved half the quantity down. Now overall 20% of the quantity on the call side is at 14,800, and I moved the remaining back up to 14,850. I don't want to get in the way of right now the calls. Even if you look at 14,750, like what the market has a downside bias. So you see, the calls are not expanding with the proportionate up move. In fact, all the way from the low of the day, where this made a low of 14.67, which is when I had to use it to balance these ports. From that point, it has hardly expanded 3 points. So an up move will blow it up eventually when there's a rush to hurry and cover. So I've moved them back up, and only 20% of the calls are now at 14,800. Time is 11 o'clock. So far, the 14,700, 14,800 range looks very good to hold based on the open interest. We have 85 lakh at 14,800, which is now the maximum call side open interest, and maximum put side open interest is 14,700. So combined premium also, if we take, you're getting 17 plus 24, so 40 points. So you can say roughly 14,650 to 14,850, which is our main triangle, is the range that market is pricing. Okay, quite the down move, expanding the puts, testing 14,700. Now this will be very interesting because there are quite a few longs built up from 14,700, a lot of puts shorted, and the average price between will be between 25 to 30, and right now this is trading at 36. So now the question is, do we see a quick unwinding or and a further cascade, or does the dip to 14,700 get bought? As usual, it's IT, right? It's IT that's moving the entire Nifty once again on the expiry. I'm thinking going forward from the next expiries and whatnot, I'm gonna trade the bank Nifty because lately I don't know what is happening with IT. I point this out every expiry. IT makes um, ununderstandable kind of moves only on expiry days. It's um, completely ridiculous. So anyway, that to balance, I had to move down the calls to 14,800, all of them, to kind of get away with the fact that these puts were rapidly expanding. And yeah, now more or less this position delta neutralizes at 14,725, and I'm still expecting the expiry range to be above 14,700. So that being the case, this is the position. We'll keep you posted. The time is 11:21. So far from the options data, what is very evident is that expiry is almost certainly between 14,600 and 14,800. The only caveat would be, and with a strong probability of 14,700 to 14,800, the only caveat is the 14,800 amount of calls that have built up. So yeah, almost 90 lakh, which is always scary because it means, okay, it should act as some kind of ceiling, but at the same time, if it doesn't, then that short covering can propel us to a new day's high, very possible. So you have to be aware of the other side when you're trending in a certain direction. Yeah, so the put side IV fell off the expansion that we saw, and we'll keep you posted. Is overall a pretty tight range, but the gamma expansion can be very fast. You can see strangle gain 8-9 points very quickly, so have to be on the toes. Okay, the time is 12:06. Something to note is, so we're seeing an up move, and I just want you to look at this. So Nifty is at 14,740, and okay, now finally these calls have started expanding. Previously, there was almost no covering of the 14,750 call despite the up move, and the 14,800 calls as well. So What I'm going to do now is I'm going to wait for 14,750 to be taken out. And if 14,750 is taken out and we hold for about two candles, or we have a runaway move till 14,770, then I will move half these calls back to 14,850. Right. So, okay. So what you can see is we're at 14,757. Now, one of two things can happen. Either the market's downside bias and will play out, which means we won't move up from here. So you see, we're above 14,750, but the call is trading cheaper by 2 points, 2.5, 3 points than the put. So market's bias is on the downside, which is why I'm not quickly adjusting this. The thing is, there is a lot of open interest built up at the 14,800, and this most likely should be defended. I don't want to uh, quickly make a change and have that reverse on me, so I'm going to wait for now. If this starts expanding to 1718, then I'll be left with no option but to square this off and sell the 14,850 call. The idea also at this point is, since I'm up about a little more than 10 points, will be to protect that um, rather than looking at too much further points to capture for the day. So, but for now, no need to rush. The market's bias is more or less holding. We're not making some big move. There's no strength coming from anywhere. Okay, so there are two things happening right now. Market is biased. So you see the 14,750 straddle is trading with the put at 33 and call at 33, and we're basically, it's in the money. The call is in the money by 7.5, 8 points, and it's not getting covered. People are not covering it, and that's scary, because which means once they start covering, they're going to cover very, very fast. So I've risked off on the call side by moving half the quantity, and I'm also now moving rest of the quantity. It's not worth it. When the market keeps biases, that's when the market can screw you over also big time, because if that bias doesn't play out as the market intends, um, right now the idea is more to protect the decay that has been captured, then try to aggressively uh, get more points for the day. What I'll do is I will risk off now. So what I've done is I've risked off. Basically, the triangle now only has 9 points, so I've booked the 14,800 calls. Not worth it. Not worth the kind of explosion we'll see on a 20-point move. This will double because of the rate of which people will cover. Look at the number of shorts that are built here. Yes, it's a fact that because the number of shorts that are built up here, will most likely see this protected, but at the same time, those who freak out will start placing massive buy orders, and that will explode the calls. So not worth it. Risk off. Taken off the call side risk and balanced it very nicely. They're sitting on a very good range, 14,650, 14,850. That's still you know 9 points in it. And towards the end, as we get into averaging, can look at moving in from the put side and call side, taking a little additional credit into the averaging period. But apart from that, I'm very comfortable to just do this. Right now, adjustment criteria is very simple. We need to head all the way to 14,800 and break 14,800 on the upside to make an adjustment to these, which I don't see happening. And for these, we have to break 14,700. So, yeah, very flat risk reward curve. We'll be able to manage this quite easily. Okay, one more thing to note is the kind of pricing that we're getting on options. So at 12:30, the at the money short straddle is worth 60 points, which means market is giving plus minus 60 from 14,750, and that is the risk that's being priced in. So on the upside you have 14,810, on the downside you have 14,690. It's very low pricing. That can mean one of two things. Either it means that because of the kind of open interest built up, there's no way that market exceeds the boundary of 14,700 on the downside and 14,800 on the upside. It's just like almost arrogant pricing by the market saying it's not going to happen, because until averaging we have 2.5 hours left to go. The other way of looking at it is the risk is underpriced and a move will burn. And if that move burns, then it will lead to rapid covering in that direction, which is even more reason why to be risk off. So I'm far beyond what the straddle pricing is suggesting at this point of time. So this gives an immense sense of comfort, and it also locks in whatever profits we've made for the day. So yeah, in case we start seeing an expansion, we are going to then make certain adjustments, but nothing till 14,700 and 14,800. We'll keep you posted. Time is 12:36. Looks like that up move for now has been negated, but that's fine. We still, whatever we gained on this call, about 2 points. And we also got out of the way of the move. You don't want to stand in the way. Yes, the move got negated and this lost 4 points and this lost only 2 points, but it's fine. It's still perfectly all right, because in case markets bias decided not to play out, there would have been a problem. Okay, the time is 1:17. What I've done now is half of the puts I have moved them up to 14,700. So the idea is potential short covering up move might get triggered, and there's a large volume of 14,700 put that is being built up. So it's also about time for me to start moving up the hedges. We'll keep you posted. Time is 1:18. Okay, something that's starting to become very evident is 14,800 and 14,700. These two seem like the boundaries for today's expiry. And the prices of options are not pricing in some kind of move, and the preferred expiry would be 14,750. Now, we've got only 1 hour 20 minutes left to go for averaging. Um, I have moved down my calls to 14,800. So I have two sets of strangles. One is 14,650, 14,850, as well as 14,700 and 14,800. The inner strangle is trading at 17 points, and the outer strangle is trading at 5. I've moved in these particular strikes at this point because I'm quite confident with the kind of open interest that is built up that the range should hold. There's almost certainly a 14,750 on the spot kind of an expiry situation. So all that being the case, 1 hour 20 minutes to go. On the outer triangle, if it start expanding to more than 22, 23, then we'll be risking off once again, because the entire idea is to protect what we've already made and not try to be aggressive and get burnt on some kind of a quick move, because options are not pricing in a lot of movement, and if that movement comes, it will be quite painful. Okay, quite a steep down move with Bank Nifty testing 32,500, and I cannot afford to risk these puts expanding into oblivion. So I have moved down the calls to 14,800 and moved all the puts to 14,650. So currently, I mean, the entire idea is I'm protecting whatever I've gained. I've gained something like 12 points, and I'm protecting that. So I'm quite certain 14,700 gets defended, but at the same time, yeah, makes sense to take risk off on the puts just in case we have a downward spiral. I most likely will move into the 14,700 puts once again, but that will be very close to averaging. So 1 hour 15 minutes to go for averaging. And as we are heading into averaging, at that point, I will move up and take additional credit. Also, I'm sure I'll get asked this question. So just want to go over this. Margin used is 3.16 crores. Out of that, for the positional trades, there's almost about 15 lakhs being used. So the actual margin used for today's position, where I'm trading how many lots? 1056 lots of Nifty. The margin being used is 3 crores. So a lot of people have a lot of speculation on what is the margin required. It is not as high as you think, because there is hedging benefit as well as MIS benefit, which is 1x leverage. 1 hour 10 minutes to go for averaging, and more or less so far Nifty is sticking to the hypothesis of a 14,750 expiry. Okay, 50 minutes to go to averaging, 100 points triangle, 50 points up and down from where I'm expecting expiry to happen. Uh, Honestly, this is just such low pricing of options. It's ridiculous. The at the money straddle with 48 minutes to go for averaging is trading at 35. 35. Uh, this put option, which is in the money by 5 points, is trading at 20. 15 is the time value given to almost 1 hour 20 minutes of market trading, and yeah, more or less continue to trail in the stop loss at this point. One of two things will happen into averaging. Either we'll see a quick 50-point move to 14,700 or 14,800, or we will not see any move, and the value of this, all these OTM options are going to crash in a matter of seconds. And if we do see a move, then the entire uh, situation is how quickly can you get out of the way of the losing position and potentially take advantage from your winning side. So that's more or less how this is going to play out. There is still 10 points in our strangle, and yeah, the risk reward in the last hour is very, very high. So as you're all aware, it's dangerous almost in that expiry in the last hour, hour and a half. So the entire premise is how quickly can you get out in case stuff start going wrong. So currently I'm up something like 4.5, 4% or so, and the idea will be regardless of what happens, I'm taking 3% home. Now there's a potential further gain from here of 2%. So we can look at this as a 2% potential payoff and 1% risk. Okay, I'm gonna give you a little insight into how I'm thinking right now with 40 minutes to go for averaging. The triangle that I have 100 points based on my data and everything. I have this view that we're going to expire in this range, right? Now, there's potentially every which way in which this can go wrong. Right now, the at the money straddle is pricing in nothing. It's pricing in nothing. It's trading at a joke of a value of 33, 34. Now, that means that the market is not expecting much of a move. But if there is a move, and that means because prices are not pricing it in, we'll have a problem. So here is my setup. This is my strangle, 14,700, 14,800 strangle. And in case I start seeing a down, the first thing I'm going to do is I'm going to start cutting. I'm going to cut risk. So I'm either going to buy the 14,750 put, which will be the inside hedge, or I will square off the 14,700. Next, I will potentially, if in the upside, the reverse. The other thing that I will do, and here I've got this set, in case there's an up move, I will buy back the put, move my put higher. If there's a down move, I'll buy back the call and move my call lower when I'm sure that it's a complete breakdown. We'll keep you posted. Time is 14:21. We will have random gamma expansion, and that doesn't call for risk management. Currently, this triangle is trading at something like 10.511. If it starts heading to 14, 15, 16, that's the point at which I have to start making changes. 38 minutes to go for averaging. Okay, we were seeing a down move, expanding the 14,700 puts, and I moved down the 14,750 calls to balance that. Currently, this triangle is trading at 17 change, just under 17. Idea is if it starts heading to 23, 24, we'll have to either adjust back, but if I don't make it in time and I start losing more than 4 or 5 points, then just take the exit for the day. 20 minutes to go for averaging. Okay, 4 minutes to go for averaging. Had to get out the 14,700 puts because they really started to expand and move them down to 14,650. At one point also moved down the calls to 14,700 to quickly take some advantage of the down move, and then exited out of them, moved them back to 14,750. Now there is 4 points in this triangle, and a potential further move that I can make is move the calls to 14,700, but that will depend what happens in the next 3 minutes of averaging. If it looks like it's definitely closing below 14,700, almost certainly, then I will take in the additional call side trade. Doing it now, quick up move into averaging will completely burn. 14,700 is, I mean, expiries prefer to be on round numbers. So depending on what happens, we'll have to make appropriate adjustments. So yeah, the down move cost us like 2.5 points, but fair enough. This is the exact thing that I was talking about. These puts were trading at in their lows like 4 or 5, and they've expanded all the way to 27. To be able to get out of them is what will make the difference in the longer run. Now, time to move the calls down. Half of them. 2 minutes to go for averaging. I have an exit order ready for the 14,650 puts. Whereas on the 14,750 Straddle must have really got. Okay, averaging is started, and into averaging seems like we're making an up move. You gotta move up the puts. Okay, really burnt myself there. The last minute move was not in line with expectation. Hmm. Yeah, it's a little too late to react. Also, doesn't help that I don't have my mouse, but fair enough. Still should be ending with a good 2% positive, so that is a good enough outcome for the day. Okay, so about 70 paisa left to decay. It will basically end up closing us at around 2% positive for the day. I think could have managed it better. I think towards the end I should have just cut out on the down move and then not tried to short the 14,700 call. So I got burnt on the put side as well as the call side. And yeah, it happens. I mean, these kind of tricky last moment moves in expiries do happen. That's why the reward is also so great because the risk is also quite high. Um, Regardless, I'm just happy that it's a green expiry. All said and done. We'll keep you posted. Auto square off should happen in about 9 minutes. Okay, should be getting auto squared off in a minute. And yeah, we'll be closing more or less slightly under 2% up on the capital used. Now, today is a good lesson to understand that, you know, you can't consider your mark to market your profit. It is not over until it's over, and that's the nature of the market. Risk was being slightly underpriced, definitely. That's for sure. And that's probably why somebody took some massive advantage of that. So the big dip with the long unwinding all the way till 14,650 would have really burnt. Managed to still cut out despite some mismanagement at that point, not being quick enough to react. Um, but still, I mean, can't complain. It's a 2% up day. Also, to anybody who has questions like how does it affect you on your psychology, it doesn't. You can't let this affect you. This mostly stems from people when they enter trades without really understanding the risk. Like people think they're risk takers, but they're not. They don't understand the risk. You can only say you understand the risk and accept the risk if you are comfortable with that risky outcome materializing, which most people are not. You hope for the reward, and the risk is not something you really factor in. So all that said, that I hope you had a good trading day. I hope you didn't. None of you got burnt by that last minute down move. I think it should have given you enough time to react. So yeah, thank you so much for watching. That's more or less the auto square off. Yeah, it's like a lot of orders. Yeah, done for the day. Thank you guys for watching. I will catch you on Friday. Um, wish you all a very happy Ramadan, and please have a great time with your family. Take care.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.